As the new year begins, global economic conditions remain mixed and the outlook uncertain. While headline inflation continues to ease, in much of the world, core inflation remains sticky and high. Both advanced and emerging economies are likely to see modest economic growth this year, despite better than expected outcomes in 2023. In most countries, reaching inflation targets, reducing fiscal deficits, and containing or lowering debt levels will stay as key policy priorities. Financing conditions are expected to remain tight. The longer-term economic outlook is also uncertain, as geopolitical tensions and climate change threaten supply chains, output, and prices. The uncertainty, alongside high interest rates and debt, will dampen investor appetite and capital flows, resulting in volatile financial markets and asset prices. Taking these and other factors into account, the SARB's forecast expects a relatively weak global growth of 2.6% in 2024. The domestic GDP outcome for the third quarter of 2023 was weaker than expected at a negative 0.2%. We expect the fourth quarter to show some improvement, with output expanding by 0.4%. The weaker performance of the economy in the latter half of 2023 is in line with the bank's forecast. The operation of ports and rail has become a serious constraint, and alongside electricity shortages, contributed to weak output growth and higher costs last year. These constraints are expected to persist, severely limiting potential growth of the economy. While we expect electricity supply to increase gradually over the longer term, its contribution to short and medium-term growth has not been revised after the upward adjustment made at the time of the November meeting. On the demand side, household consumption and investment have eased significantly, while government spending has been sustained. As we highlighted throughout last year, commodity export prices have receded sharply from the highs reached in 2022, reducing the contribution of foreign demand to growth. For 2023 as a whole, GDP growth is revised down slightly to 0.6% from the November figure of 0.8%. Our GDP growth forecast for 2024 and 2025 is unchanged from the previous meeting at 1.2% and 1.3% respectively. At present, we assess the risks to the medium-term domestic growth outlook to be balanced. With the weaker GDP outcome in 2023, our current growth forecast leaves the output gap marginally negative and at zero in the outer years of the forecast. Compared to many other emerging and advanced economies, the rise in South Africa's headline inflation rate was more gradual and peaked lower. However, the return to target has been slow. The inflation rate remains sensitive to changes to both global and domestic supply and demand. Due to global factors, oil prices remain generally high at around $82 per barrel. We expect them, however, to be somewhat lower this year and next compared to the November forecast. Commodity export prices fell sharply last year, by about 27% and are expected to fall by a further 12% this year. As a result, and despite modest economic growth, South Africa's external financing needs will increase as the current account deficit expands. We expect a deficit of 1.4% of GDP in 2023, rising to 2.8% of GDP in 2024 and 3.6% of GDP in 2025. The uncertainties of the global environment and various South Africa-specific factors, including sluggish growth and dependence on commodity export prices, continue to weigh on the value of the currency. The rand depreciated over the past year by about 11% against the US dollar, making it one of the worst performing emerging market currencies. The implied starting point for the rand forecast is 18.65 to the US dollar compared to 18.69 at the time of the previous meeting. Fuel price inflation is expected to be low, averaging below 1% in 2024. Food price inflation is revised slightly higher for 2024 to 5.7%, but remains broadly unchanged over the forecast period. Core inflation was 4.9% in 2023. The core inflation forecast for 2024 and 2025 is little changed at 4.6% and 4.5% in 2026. Services inflation in 2023 was 4.2%. The forecast for 2024 services price inflation remains unchanged at 4.8%. Core goods inflation was 6.1% in 2023 and is forecast to ease to 4.5% this year. While average salaries grew less than expected in the latter half of 2023, they are forecast to hit long-term averages for the rest of the forecast period. Headline inflation was 6% in 2023. With few significant changes to the forecast for underlying components, headline inflation is expected to ease to 5% for 2024, to 4.6% in 2025, and to 4.5% in 2026. While our baseline inflation forecast is of continued gradual moderation in global and domestic inflation, the risks to the outlook are still assessed to the upside. Better than expected global growth last year and ongoing geopolitical tensions this year serve to keep oil markets tight. Despite some improvements, advanced economies continue to experience strong wage growth and elevated core inflation. South Africa's imported goods inflation increased strongly last year and despite some better recent outcomes, remains sensitive to currency weakness. Recent increases in egg and potato prices remind us that domestic food price inflation remains unpredictable and high. Electricity prices and logistics constraints continue to present clear inflation risks. With fuel and food price inflation remaining volatile, risk still attaches to the forecast for average salaries. Housing and services prices, more broadly and in contrast, may continue to provide some downside relief to the inflation risk profile. Sticky inflation in G3 economies implies that their average policy rates will remain elevated at about 4.3% in 2024 compared to 1.1% average seen in 2022. These tighter global financial conditions raise the risk profile of economies needing foreign capital. South Africa's long-term cost of borrowing is expected to remain, and despite moderating inflation, long-term bond yields currently trade around 12%. The rise in inflation in 2022 generally resulted in higher inflation expectations across markets, businesses, and households in 2023. Medium and longer-term market expectations for inflation remain elevated. The December survey of the Bureau for Economic Research shows average inflation expectations increased to 5.9% for 2024. Achieving permanently lower inflation and interest rates requires inflation expectations to be closely anchored to the midpoint of the target band. Against this backdrop, the MPC decided to keep the repurchase rate at its current level of 8.25% per year. The decision was unanimous. At the current repurchase rate level, policy is restrictive, consistent with the inflation outlook and the need to address rising inflation expectations. Serious upside risks to the inflation trajectory from global and domestic sources are evident, and as noted earlier, the economic outlook is highly uncertain. The inflation and repo rate projections from the updated QPM remain a broad policy guide, changing from meeting to meeting in response to new data. Future committee decisions will be data dependent and sensitive to the balance of risks to the outlook. Guiding inflation expectations back towards the midpoint of the target band will improve the economic outlook and reduce borrowing costs. Since early 2020, the committee has recommended additional means of strengthening economic conditions, including achieving a prudent public debt level, increasing the supply of energy, keeping administered price inflation low, and real wage growth in line with productivity gains. Such steps would also strengthen monetary policy effectiveness and its transmission to the broader economy.